Well, welcome to week 5, video 2 for PSC 355. And in this video, we're going to be discussing capital flows and currency wars. So the central question we're going to answer in this video is, what is the downside to an international monetary system based on floating exchange rates? Now, we've already touched on some of this in the previous video, but I want to spend a few minutes kind of fleshing out a little bit more what exactly determines the exchange rate of a currency when it floats. So the value of a floating exchange rate is largely determined by the supply and demand for currency in international currency markets relative to other currencies. So in general, if the market, and this includes individuals but also big investment funds and banks, if the market is selling US dollars to buy Japanese yen, then the dollar will weaken against the yen and vice versa. Right? Because you're selling dollars, demand for dollars is falling, you're buying yen, demand for yen is rising, and so therefore the yen should become a stronger currency, the dollar a weaker currency. Now, why would investors buy and sell currencies? Well, a key reason is that investors buy and sell currencies in order to make investments abroad. So an American that's investing in Japan's stock market, they have to have yen. You can't invest in Japan's stock market using dollars. So you have to sell your dollars if you're an American, and you have to buy yen in order to complete that transaction. Right? So it's a pretty straightforward transaction. Hey, I want to invest in Japan's economy and its financial markets. I'm going to sell dollars, less demand for dollars. I'm going to buy yen, more demand for yen, and that's going to affect exchange rates. Investors also buy and sell currencies as investments themselves, and they try to profit off the changes in the values. This is a lot like trading stocks, and it's called currency speculation. And so sometimes purchasing and selling of currencies has nothing to do with the decision to invest in that currency. It's just a decision to try and profit off of changes in exchange rates. Now, we noted before that governments have to make a decision between these three options according to Mundell-Fleming or the unholy trinity. In the world today, most advanced industrial and even most emerging market countries today have given up fixed exchange rates. It's something that existed in the past. You've read this week about the Bretton Woods system, which existed from 1944 until 1971. In the Bretton Woods system, governments chose to have fixed exchange rates. But after 1971, increasingly governments have given up fixed exchange rates and decided that they want to have capital mobility. They want to allow investors to move money into their country and out of their country. And they want to have independent monetary policy. That is, they want to be able to set interest rates based off of their domestic economic needs. So they've chosen independence and capital mobility. Now, the thing we want to discuss in this video is one of the downsides to this option, or to this choice of monetary policy. If you give up the fixed exchange rate and you have a floating exchange rate, well, there can be some conflict that arises. Because, for instance, if rates rise in a given country, right, that's going to attract money in. The inverse is also true. If rates fall, then money's going to flow out. So all else equal, when capital flows into the country, what's this going to do to the exchange rate? It's going to strengthen the exchange rate. Recall from the previous slide, we said, hey, if money's flowing into that economy, that means individuals and investors are exchanging their local money for that domestic currency. So if money's flowing into the US, you're exchanging, say, your Japanese yen or your euros, and you're buying dollars. That's going to increase demand for the US dollar. It's going to mean that the US exchange rate is going to appreciate or strengthen. Then the inverse is true. If rates fall and money flows out, that's going to weaken the exchange rate. The basic point here is monetary policy, interest rates, affect exchange rates in a world where capital is mobile and where exchange rates are floating. As I noted, this can lead to conflict. In 2010, the Brazilian finance minister, Guido Mantega, once said, "We are in the midst of an international currency war, a general weakening of currency. This threatens us because it takes away our competitiveness." What Finance Minister Mantega was pointing to was that after the financial crisis in 2008, a number of central banks, Japan, South Korea, Taiwan, and even the US, adopted very, very low interest rate policies. The US in particular, after 2008 up until around 2013, had the lowest interest rates in American history. And this was designed to promote economic growth and employment in the US. But remember, it had the effect of capital flows moving out of the US. And the argument from Brazil's finance minister was that it was causing his country's currency to appreciate. And we know that a stronger currency hurts export competitiveness. So, what we have here is a situation where the United States and Brazil, two countries, have each chosen monetary policy autonomy, and they've chosen international capital mobility. They've given up the stability of a fixed exchange rate. And so as the US lowered interest rates, what that meant was that money left the US where returns were weak and flowed to countries like Brazil or India or Turkey where returns were much greater because interest rates were higher. And so what that meant is that the Brazilian real strengthened vis-a-vis the dollar and the US dollar weakened vis-a-vis the real. If we take a look here at between May of 2009 and May of 2011, you can see that the Brazilian real strengthened significantly, about 33% against the US dollar in that period of time. Of course, that had adverse effects on Brazil's export competitiveness. Now, the inverse is also true. Around 2013 and into 2014, the United States began having conversations about raising U.S. interest rates. And when this discussion began, money was attracted back into the U.S. It was sucked out of Brazil and these other countries. And of course, that meant that as individuals and investors sold real and bought dollars, the dollar strengthened vis-a-vis the real, and the Brazilian real weakened relative to the dollar. So take a look at what happened in the second half of this graph. The exact opposite. The real depreciated or weakened significantly, about 33% against the US dollar from the fall of 2012 to the summer of 2014. And it happened so quickly that this affected Brazilian citizens in a negative way because all of a sudden their purchasing power was stripped away from them. And so you can see why countries like Brazil or India or Turkey that are on the receiving end of these capital flows, one way or the other, sometimes can get a little bit upset about monetary policy in countries like the US, where a lot of capital is coming from or going to. The bottom line here about floating exchange rates is that changes in exchange rates have real implications for individuals in an economy. If it makes exports less competitive, it's going to hurt producers and manufacturers in those countries. Or if it weakens significantly, it's going to hurt consumers, as prices are going to rise of foreign goods that they would want to purchase. Now, in practice, these changes allow for what we would call automatic balance of payments adjustment. Now, you read about the balance of payments. It's a complicated process, I understand, but allowing the exchange rate to move up or down is going to affect trade, which is going to affect the net flow of money into a country and can balance the balance of payments. And so that's a good thing. But currency fluctuations have consequences. As we already said, appreciation can hurt export-oriented and import-competing industries, and depreciation hurts consumers. The possibility for government intervention can generate conflict and mistrust. Another basic point I want to make here is that there's sometimes disagreement and misunderstanding in the international system. Brazil looked at the US and said, look, are you really lowering interest rates because you're worried about unemployment? Or did you lower interest rates to cause capital outflows to weaken your currency and become more competitive in trade? In other words, sometimes concerns about monetary policy and exchange rates can be viewed as protectionism or veiled or disguised trade policies. And so that can lead to a lot of conflict and mistrust. A video that you're going to watch next, video 3 this week, is a clip about currency wars that highlights these concerns and again makes it clear that exchange rates that float, while there are many good things about them, can generate conflict because of these currency war concerns.